Welcome back. We are 5 minutes away from the July jobs report. It could be a market mover. Economists are expecting 80,000 non-farm jobs to have been created in the month of July, with the unemployment rate holding steady at 4.2%. I have also seen it as high as 82,000 is what some are expecting. Joining me now is Allianz's chief economic advisor, Mohammed El-Erian, Unleash Prosperity co-founder and former Trump economic advisor, Steve Moore, and El-Erian Associates founder and chief investment officer, Louis Navellier. Also with me this morning is Charles Payne, John Lonsky, and Lauren Simonetti. Great to see everybody. Thank you so much for being with us for this all-hands-on-deck session as we await the jobs numbers. Mohammed El-Erian, let me kick it off with you, because when we talk about jobs in the economy, oftentimes all questions and conversation goes to the Fed. And you wrote a fantastic op-ed in the Financial Times that Kevin Warsh is being misunderstood. Tell us about it.
Yes, I think finally we have a Fed chair committed to reforming the Fed, and the Fed needs reform. It has slipped on so many different aspects, Maria, over the last 5 years. And instead of focusing on the reforms, instead of focusing on its reaction function, you have people complaining they're not being spoon-fed. And I think that is a really unfortunate issue. I think today's labor report is going to support the new Fed chair in doing what he's doing, which is trying to reform the Fed, bringing inflation down and making sure that the Fed supports productivity and economic growth.
Yeah, it's a great point. And Steve Moore, I mean, you know, to see these expectations of a rate hike, I talked to Charles about it a minute ago because, you know, Tom Lee at Fundstrat says that these markets and investors have excessive inflation derangement syndrome. And he's not expecting a rate hike. Neither am I. Your thoughts?
Nor am I. By the way, Mohammed has it exactly right that this new Fed chairman, Kevin Warsh, who is someone I've strongly supported, is an inflation hawk. He views his goal as not to solve climate change or create jobs. It is to get inflation down below 2%. I think he wants eventually to get to zero, which would be fantastic for the U.S. economy. And by the way, this is the important thing that a lot of people on Wall Street miss. If you want to bring interest rates down, the best way to bring interest rates down is to bring inflation down. Inflation comes down, interest rates come down, borrowing costs fall, and you get a big stimulus to the economy. So I'm very high on him. And I agree entirely with what you guys were saying earlier, you and Charles. We are in the beginning stage of a productivity boom. And what does that mean? We're producing more and more goods and services at lower cost. That's deflationary, not inflationary.
That's exactly right. And we're going to talk more about productivity once we get these numbers out. But Louis Navellier, how important is this report as an investor? You've been very bullish. You've been very right on this market. Louis, would you expect that we see a little of what we saw in the ADP numbers, which actually was a little softness in terms of private job creation?
Yeah, I don't want a strong payroll report because the stronger it is, the more pressure there is on the Fed to raise rates, and we don't want the Fed to raise rates. So as Steve pointed out, the productivity gains are incredible, and that should keep wages low. That should obviously boost GDP growth. We're already getting a lot of signals on that this week. So I would like a disappointing report.
You want a disappointing report. By the way, economists are estimating that only 20 to 50,000 jobs a month are needed right now to keep pace with population growth. So the old assumption that anything below 100,000 is recessionary doesn't really hold at all. But, John, in terms of the macro story, we have been seeing low inflation and growth.
We have seen a lot of growth, and I was really shocked. I came across this forecast from GDP Now. They are calling for a 5.8% quarterly annualized increase by third quarter real GDP. My goodness. So that tells us to throw that 1.5% growth from the second quarter out the window. I think what you want to focus on, though, when you look at economic growth is what is happening to real private sector sector spending on final products. That's basically the spending of consumers and businesses. That grew by 3.9% in the second quarter, despite 1.5% GDP growth, and is expected to grow by faster than 4.6% current quarter.
Let's get to Lauren with the numbers. Go ahead, Lauren.
Minus 23,000. No rebound for the July jobs report. Negative 23,000. Unemployment rate drops in July to 4.1% from 4.2% in June, and the same for the expectation. The number of unemployed drops from 7.1 million to 6.9 million. Where are other jobs, Maria? Well, manufacturing, bright spot, better than expected, created 5,000 jobs in the month. But again, a disappointing jobs report. Dow futures way up, doubling where they were before. I'm going to continue to dig through to tell you where the jobs are and are not, Maria.
All right, thank you, Lauren. 23,000 jobs lost in the month of July. Louis, you wanted a weak report. You got it. Was this too weak?
No, not at all. You know, when Palantir announced their earnings, they basically had record earnings by decreasing their sales force. So there's this AI productivity boom underway, and it's obvious what's happening. But no, this is great news. That's why the market's up, and now the Fed has an unemployment mandate, and so this is great news. And obviously, a lot of people disappeared from the workforce if the unemployment rate dropped.
Charles, your reaction?
Yeah, I mean, we got to go through it, but Louis just made that last point. You know, fewer jobs, but a lower unemployment rate, fewer unemployed. Looks like a participation situation here. I want to get the wages, but I like that part with the manufacturing.
Wages are 3.2% on an annual basis.
Okay, 3.2%. No pressure on Warsh. He might be sitting back smiling at everyone who went nuts last Wednesday because we had a PCE number that was better than expected, and now this jobs report. So that's good. The Fed's out of the picture, at least for today. The manufacturing part of this, I think, dovetails with what I was talking about, this manufacturing miracle going on. And, it's the rest of it, we've got to look at the details. Obviously, the market's reaction to digesting this, it could be completely different at the end of the day. But we've got a pretty good tailwind in this market right now, and this should not hurt this market today.
No, this market's going well. It is up 231 on the NASDAQ, and the Dow Industrial's up 104. Look, to see the negative 23,000 for the month of July, Lauren, you've also got revisions to report.
I will get the revisions for you. I wanted to tell you where we're losing jobs in the economy first, if I can here. Retail lost 19,000 jobs. Government down by 53,000. Leisure and hospitality. What about the World Cup hiring? Down 40,000 in the month. Bright spots, as I noted, manufacturing up 5,000. Construction up 22,000. So there are bright spots, but that is where the jobs are and are not. If anyone has revisions right now, I'll take them.
Okay, we will wait on that. Steve Moore, I want to get your take on the macro story and this productivity story. We keep talking about productivity on fire, and the Treasury Secretary talked about it with me weeks ago. Here's what Scott Bessent said on productivity right now. Watch.
This is a generational technological boost. President Trump came in and became one of the great supporters of this very important technology. President Trump is allowing the AI companies and the data centers to build their own power generation. So we're seeing it there. We're seeing it up the supply chain, and this is kind of a once in a generation or build out. On the other side of this, we are going to see big productivity growth, and really that's how you increase national wealth, is through productivity growth. The U.S. is the home for this.
Steve Moore, your reaction. Steve.
I totally agree with what Scott Bessent just said. He's exactly right. Productivity is what drives growth. But here's the really interesting thing about those numbers Lauren was just talking about. We buried the lead a little bit here because we saw a big reduction in, if I heard Lauren correctly, a big reduction in government hiring, which is a good thing. We want the government to shrink. That's called draining the swamp in Washington. We had a net, if I got those numbers right, we had a net sector hiring and a reduction in
Steve, we can't really hear you very well. Steve, you're going in and out.
That's exactly the opposite.
Yeah, I know that's what we want. Let me get to Mohammed El-Erian. We can't hear you well, Steve. Mohammed, in terms of wages being up 3.2%, a decline in jobs down 23,000, and the unemployment rate at 4.1%, your reaction?
So first, I think this takes the focus off the Fed, and if core CPI is well behaved next week, which I expect, the focus is going to continue to shift off the Fed. Second, Steve and I talked about this last month on your show. It's the supply side of the labor market we have to focus on. And I suspect that what we're seeing is a combination of two things. On the demand side is the World Cup, but more important is what's happened to the supply side.
You got it.
And that speaks to the unemployment rate coming down to 4.1%. So it's important to focus not just on the demand for labor, but the supply for labor. And third, I agree with everybody. The key to our future and our kids' future is going to be in productivity growth. And the outlook for that is very bright.
Mm-hmm. Yep. And we also have revisions actually for June and other revisions. Lauren, did you have those numbers?
Revisions for June, Maria, down by 37,000. May down by 66. Combined 103,000 fewer jobs created in the months of May and June, Maria.
Yeah. And that is all about the market reaction today is all about what this means for the Federal Reserve. Louis Naviler, how do you want to allocate capital in this environment where, once again, we're talking about Goldilocks, a Goldilocks macro story?
Yeah, you know, the last I looked, FactSet was forecasting 47.4% annual earnings growth for the S&P this year, but that was before Palantir's blowout results. So we might hit 50% earnings growth on the S&P right now. That's unbelievable. And you just can't ignore all these good earnings. So I like stocks on dips. Anything that is strong that pull back, like SanDisk the other day, just back up the truck. You know, it's Micron, if it dips, buy that. I think the leverage ETFs have caused a lot of damage on Wall Street. And a lot of chaos, but you can't ignore these earnings. You just can't. It's a wonderful thing.
Yeah, the earnings have been up 51% year over year. It's absolutely extraordinary. And you're seeing that play out for companies in the second quarter on top of the similar story in the first quarter. So, Charles, the earnings backdrop very strong. The economic story, one of productivity. And yet you've got job losses in July and June and May as well. How do you see this?
Well, shout out to Vanguard, said look for a big revision downward. They had 18,000 the lowest. And, you know, it's one of these things. Sometimes I look at where the jobs are lost. So if you look at the pay scale, the very lowest paid jobs are retail. The second lowest paid jobs are leisure. And while we don't want to see any Americans lose, if these folks are moving toward, you know, higher paying jobs, if we have fewer people flipping burgers, not trying to be disrespectful, that's good. And Steve Moore, of course, the government stuff, that's great. So, you know, there's a way of looking at this as a net positive. And then Louis made the great point, and I started this show with you. What's happening with corporate America, corporate profits at record highs, corporate profit margins at record highs, guidance extraordinarily strong. You know, names like SanDisk, which collapsed, are looking much higher. They collapsed not for fundamental reasons. The leveraged ETFs, particularly in Korea, the emotional trading, all of that stuff conspired to make the market very shaky, but also created enormous opportunities. And this is it. You used the word Goldilocks. We're in the fourth industrial revolution. America's leading the way. Listen to what SpaceX said. You know, profitability is down the road, but listen to the vision. Listen to the vision of these companies. It's absolutely remarkable.
Yeah, I mean, look, you talk about these semiconductor stocks, and I guess it was Mark Tepper or Adam Johnson this week talking about Micron technology. And Louis, I think Micron, even though it's up 800% in the last year, I think it's trading at like 5 or 6 times earnings, which is crazy to have such a low valuation relative to where you're seeing the rest of the market. Do you agree with that?
Absolutely. And Micron has pricing power, as does all the other memory stocks, for at least another 5 quarters. I know Korea's ramping up production as fast as they can, but the memory shortage is acute. I mean, it's so bad that Apple warned that it might not be able to supply all its products because it just can't find the memory components.
And memory prices have soared because the hyperscalers are buying all the memory, and it's in scarce supply. There's the semiconductor stocks of the last year. Micron up 710% over the year. Look at SanDisk, up 2,889% in the last year. Mohammed, talk to us, broadly speaking, about this macro story and this supply chain resumption to America as we're talking about what it looks like a new industrial revolution with AI.
We are. It's an industrial revolution, and as James Manica of Google says, it's an enlightenment at the same time, because you're getting not just a general purpose technology, but you're getting an inventor of invention, and that's really powerful. Look, everything that's happening is good for the markets. And today is good both for the equity market and the fixed income market. And let's not forget the fixed income market, because that is what's providing all the funding for the investments in AI and in other places. I do worry, however, about Main Street. I worry about the supply side. I worry about the importance of retraining and retooling the labor force so that we can continue to have buy-in for this really important productivity trend that we're on. Because if we lose Main Street, it gets really hard, as you know, Maria.
Well, look, today was a test in terms of how significant the Fed's issues are. And you're right, it could actually take the Fed issue of a rate hike off the table after this jobs report. That's what Tom Lee said as well, that this upcoming July jobs report could take the issue off the table. In addition to this number, we're also focused on next week's number, John, and that is the CPI for the July period. They're expecting an increase of 0.2%. That also is another test to see where Kevin Warsh will be in terms of monetary moves this year, John.
Boy, this report definitely reduces inflation risks. My goodness. I mean, a year ago, we had wages growing 4% year to year. And in July of 2026, that wage growth is down to 3.2%. You've got to be kidding if you're trying to tell me that the labor market poses an inflation risk. Right now, it looks as though inflation risk is concentrated on the price of oil. And I would expect that at some point, we're going to have that Strait of Hormuz open for good, and when that happens, the price of oil comes down, and so does price inflation, with, of course, a lot of help from productivity growth. There's a lot of room for interest rates to move lower. If we look back just prior to the start of the Iranian conflict, 10-year Treasury yield was hovering around 4%. Maybe we're headed back towards that 4% 10-year yield by at least early next year.
Yeah, I mean, Charles, how do you want to be investing around all of this?
The great news is we're coming out of earnings season. This is the best time to be an investor, because you saw what the companies printed and you saw how the markets reacted. So there's a lot of names out there. Louis hit on a lot of them. You know, SanDisk is down a lot, is looking pretty good this morning. The some of these software names are differentiating themselves. They're not all going to be victims of AI. So you've got a big patch of names that are extraordinarily oversold there. But the most important part is you want to be invested. You don't want to be shaken out of this market. Every little scare that we have, in fact, most of the times they've been opportunities, just like this last one.
Well, sure. And Lauren, we are also looking ahead to the latest developments out of the Iran war and also the inflation numbers next week.
Yeah,
what's on your radar for the week ahead, Lauren?
The price of oil. Any further attacks and/or deals to open and potentially charge to get natural gas and oil through the key shipping lane, which is the Strait of Hormuz, also watching what's going on in the Red Sea. Maria, I look at teenage unemployment sometimes to see what types of jobs are being created, and those jobs where a computer can easily replace you. Teen unemployment, 12.1% in July. In June, it was 14.6%. And I'm wondering why we saw the decline, if anybody wants to weigh in the number of teenagers that are working right now, in the percentage.
What do you think?
I have a guess.
Go ahead.
You know, my guess would be that one of the reasons why you had a loss of 44,000 jobs in leisure and hospitality is because you have fewer foreign-born workers in the United States. We had, you know, an end to illegal entry across the border. We've had the deportations, and perhaps teenagers are benefiting from this reduced supply of foreign-born labor.
Mm-hmm. Yep. Right. We'll see. 61.4% participation earnings ease. We're looking at reaction this morning from Wall Street firms on what we are seeing for this employment report. And it was obviously weaker than expected, but it did cause a big rally in stocks as it suggests that a rate hike is perhaps lesser of an eventuality for the Federal Reserve. And here is the list of the jobs created and lost. Leisure and hospitality down 40,000, as John just mentioned. But construction was up 22,000. Manufacturing was up 5,000. Private education and health services up 25,000. Mohammed, healthcare has been one of the leading areas in terms of job creation for some time. But you're also seeing construction and manufacturing also create big opportunities with this AI build-out.
You are, and you saw it in the ISM manufacturing numbers, which were much stronger than expected. I'm so glad you mentioned the labor force participation. You said it was 61.4. The previous reading was 61.5, and it was expected to go to 61.6. Fewer people are in the labor market, and that is the problem. We don't have enough workers for the sort of demand we need, or we don't have the right skill mix. And I think that is a key issue. So it's really important to keep on focusing on this number going forward, because we've all been hoping that this number will go up, but it has stagnated, and in fact, today it went down.
Mm-hmm. Yeah. It's a great point, and we'll watch that in terms of next moves. Steve Moore, are you with us?
I am. Can you hear me now?
Yes, I can. Thank you so much for fixing that, because we couldn't hear you well. But, Steve, I want to get your reaction and your thoughts on a market that has basically soared on a weaker-than-expected July report on jobs. The NASDAQ is now up better than 1%, 344 points higher, as tech leads the rally this morning on this idea that perhaps, given this weak report for the month of July, it takes some pressure off the Federal Reserve to raise rates.
Well, it may, but look, I think the most important point of this report, and it's something that's been happening not just in this report, but for the last year or two, is exactly what Mohammed just said, which we're facing a very disturbing reduction in the number of people of working age that are in the workforce. And you know, Maria, the demographic that's really troubling here is males between the ages of 18 and 35. There's been a big continuing decline in the number of males in that prime working age that are working. And we can't quite figure out what is happening there, but we have to get them back in the workforce. Two other quick points, and I just want to reiterate what was said earlier. This isn't such a bad report when you have 54,000 reduction in government employment. We want that to happen. We want government to shrink and the private sector to grow. And that's exactly the opposite, Maria, of what happened under Biden. Remember when we would do the reports under Biden, we get these good jobs report, and half the jobs were in government. We don't want that. We want private sector growth. We're getting that, but we have to figure out how to get people back in the workforce, incentivize them. It doesn't help when we're paying people not to work. And finally, let's not forget, because the leftists say, look, job growth hasn't been as strong under Trump as it was, say, under Biden. And that's also partly because we've removed millions of illegal immigrants into the country. So that's been, you know, that has reduced the number. So for people who live here and are citizens, the jobs are there. And so I would view this as not a bad report.
Lauren, your reaction.
I'm seeing some movement now with Fed futures and the pricing in of a potential rate cut or rate hike. Before the report and right after it, there was a 54% chance that the Kevin Warsh Fed would hike rates in 40 days when they meet again. That 54% has now gone down to 46%, Maria.
Okay, there you go. Yes, and that's what we were expecting, and that is why stocks traded higher right after the numbers. So Louis Navellier, what do you want to do here? I mean, I know that you want to own stocks. You want to certainly capitalize on what has been a very strong macro story. But Louis, in terms of sectors, where do you want to be?
Well, it's still semis. It's still energy. Because of the refinery shortages. I have tons of Eli Lilly they beat. That's my only drug stock, but I have a huge weight in that. So I like anything that earns money, period. And the market's trying to broaden out here. So I hope to eventually have a retail stock one day. I don't, but I'm very, very encouraged. And also, let's face it, the Magnificent Seven's looking a little better with Amazon, Microsoft back in the game. So there's a lot of positive things happening.
I wonder if the midterms matter in terms of the investing playing field, Charles. I mean, look, we don't know what will happen with the House majority, but if the House loses the majority, every committee will become investigatory committees that the Democrats are running. Whether that changes policy in a significant way for corporate America, because the big, beautiful bill created all of this opportunity for corporate America to write things off, expenses, and then there was the individual tax cuts as well, no tax on tips and Social Security and overtime. So if we actually see a change in the midterms, how does that play into things?
Well, first of all, I'm with you. I don't think that's a slam dunk. And secondly, this makes 2025 look brilliant. When President Trump forced Republicans to put together one big, beautiful bill. They wanted to piecemeal it. They wanted the same usual, get a room, put these Christmas trees together, the same old, the horse trading kind of thing that got us in this predicament in the first place. So what I'm saying is that the good news is that a lot of the policies are already in place. That's why immediately in January, we saw manufacturing go to expansion immediately, and it's kept going higher. I do worry, though, about, Steve brought it up, so did Mohammed. The employment, participation is important, but it's not a new phenomenon. We peaked in January of 2000 at 67%. We went to a low of 60% during COVID, bounced back to 63, and it's been back downhill again. There's something wrong, and I think a lot of it, and John Lonsky had a brilliant answer to the teen employment thing. A lot of it is just Americans have been forsaken. Young Americans have been looked over, and now this is their window, their opportunity. They've got to train up. They've got to get these opportunities. The good news is that they're out there. We're bringing back manufacturing. Look at this Terrafab that they're going to build in Texas. It's the biggest building in the world. It'll be 100 million square feet. There's opportunities out there. We got to train young people to get it. The stock market's going to take care of itself, particularly if the Fed's not forced to hike rates. And I think Kevin Warsh is going to stand firm.
Absolutely. Micron, by the way, is up 4% right now. Mohammed, your reaction to what you're hearing from Charles?
So I agree with Charles, and I love the phrase, they've got to train up. I wrote it down, Charles. I'm somewhat less bullish than Louis and Charles, not because of fundamentals. I think the fundamentals are flashing green, not because of valuation, but because of what's known as technicals. There's still leverage in the system. There's still massive leverage in Korea. That spills back to us. We haven't sorted out the Japanese yen yet. And there's a tremendous amount of demand for funds from the tech companies. So I love the fundamentals. I think valuations are fine. Just keep an eye on these technicals. We need to get these bad technicals out of the way. We've got a good amount of leverage out, but there's still quite a bit left. And Jamie Dimon made a big point of this 2 days ago.
Yep, it's true. And look, we're looking at a macro story that is in growth mode, regardless of the jobs numbers for the month of July. Here's Scott Bessent, Treasury Secretary, on his expectations for second half of the year. Watch this. What would be your expectation for growth in the second half of the year, Secretary?
I'm not going to give a guess, but I think that 3% is minimum, not unreasonable, and I think we can start coming back towards the Fed's target level. I think PCE inflation versus CPI inflation. PCE has some quirky things in it where, like the stock market goes up, and because of portfolio management costs, the costs are going up. I think those are going to be adjusted this year.
Yeah.
So I think inflation's under control.
Your thoughts, Steve?
Yeah, no, look, I think 3% growth is very achievable. I would be on the higher side of that. I think we could get to 3.5% growth. But again, I want to make this point. We don't have a problem of unemployment. We have a shortage of workers in this country, Maria. We do. We have a shortage. You've reported on this many times. Look at the demand for electricians. Look at the demand for mechanics. Look for the demand for people who have valuable skills. Talk to employers. They will tell you we can't find enough workers to fill these jobs.
Yeah, well, for sure. And that's why, Charles was saying train up. People need to be trained in this new environment, and that's what we're seeing on the part of corporations as well. Companies are training their people in terms of AI. But, John Lonsky, when you look at the broader story, everybody was worried. There was so much hysteria, first over the president's tariffs, and then the hysteria over the Iran war. Democrats trying to upend his agenda. And here we are looking at yields plummeting. Look at the 10-year right now, John. It's down almost 6 basis, down 6 basis points right now. The 10-year back down to 4.6%. Oil prices way down from the highs. And you've got a story on the macro, a situation of growth.
Yeah, the macro situation with growth. I mean, I can't think of a recession that was accompanied by a corporate earnings growth of 20% or higher. I don't think that has ever happened. So I have a lot of confidence that the ongoing growth of corporate earnings is going to see to it that eventually we see more in terms of jobs creation. But in order to get jobs creation, we have to have labor that's qualified to fill these job openings. And unfortunately, we've had a deterioration in the education system. A lot of education lost sight of the fundamentals. Instead, they're looking at social issues. They're looking at the importance of being woke and stuff like that. That's got to change. And I think once the young people in this country are aware of the tremendous opportunities that are available to them, regardless of how academically inclined they might be, they're going to step in and take advantage of these opportunities.
Yeah, I agree with that. But Louis Navellier, how important is policy to you? If we see a change in the midterms, what does that mean for you? What does that mean for your expectation that this euphoria continues? You know why, Louis? Louis Navellier, policy matters.
Oh, I'm sorry. Yeah, I didn't realize that was the question.
He was counting his money in his head. That's all, Maria. He was just counting his money.
No, Trump has front-loaded all his agenda. So even if there is a change in Congress, it's already in the pipeline. All the spending's in the pipeline. They can't stop it.
That's a good point. Yeah. Well, the big, beautiful bill definitely front load. But, Steve, they're talking about a reconciliation 3.0. The Senate is leaving this week, not having gotten the president's agenda across the finish line. We're waiting on the Save America Act. We're waiting on the Clarity Act, the NDAA. I mean, I think we're lucky to see a CR and a Russia sanctions bill get done tonight. That's it. Until September 14th.
On the policy front, on the policy front, I'm with our buddy Larry Kudlow. I mean, as you know, he's been on this bandstand. We've got to get maybe a capital gains tax indexing in this bill. Republicans need to have a continued pro-economic growth message. Obviously, the big, beautiful bill had a hugely positive effect. You were 100% correct on that, Charles, in terms of encouraging investment. So we definitely need that. And when you ask me what is the biggest fear that I have on the economy, you know what it is, Maria? If all these crazy Democratic socialists start to win their races, that's bad news for the economy.
Right, and that's what I'm saying, because policy matters. And if we see policy completely change against what the president has in his agenda, that will matter. That will impact financial markets and corporate balance sheets. This is a great conversation, guys. I want to thank you all for joining us this morning. Mohammed El-Erian, Steve Moore, Louis Navellier, Charles Payne, and John Lonsky. Thank you so much, everybody.